Okay, let's go with this question. This is question from chapter 11. On July 10, this company, a business located in Alberta, purchased 20,000 inventory for resale on account. On July 25th, they recorded the sale on the merchandising on account for $30,000 plus taxes. On August 10, they remitted the GST to the receiver general. They had no other sales or input tax credits to analyze those transactions. So what we have to, that's a very simple question, very nothing scary here, nothing uh, hidden. You just have to order the purchase with GST on account. Then you have to record the journal entry for the sales with GST on account, and to see what has to be paid, what has to be submitted, or has to be refunded or claim refund from the receiver general, which receiver general says I cannot do everything. So let's go. First journal entry will be, let's make it a little bit bigger here so we can see everything. 20. Okay, first will be July 10th. That's the first entry on July 10. We're going to have debit. Obviously, we're purchasing inventory, debit inventory. And then we're going to have how much inventory we purchase, and that will be our inventory. In this case, will be purchased for $20,000 inventory. Let's leave here one line. This, and that will be the next one's gonna be something like this, and then we're gonna go debit here and credit here. That will be our debit, and that will be our credit. Let me see if that's how it is on the environment that you're gonna take the exam. Yeah, it's pretty much the same. So let's go. Debit, inventory, credit. Now we have another debit, right? Then will be another debit, GST. That will be GST. How we call it this GST that we pay? It says on the, if you see here, it already says. So in the questions already gave you, recoverable. You don't have to think about it. You don't even have to wonder, what was the GST here? Should I open the textbook or should I go? It says there, GST recoverable. So recoverable, boom, done. And then we have to do the journal entry. GST is 20, inventory is 20,000. GST is already given to you, 5% in Alberta and everywhere, the 5%. Now, the tricky part is they're trying to increase it. Imagine this, the Canadian government tried to increase the GST to 5, even 6, 6, even 7%. So they can spend more money on some nice stuff. And then we have credit. Since we're not paying it, that will be accounts payable. 20,000. The nice stuff is not medical system, not education, not on the improve of the young generation, nothing like that. Something else. Now, the next one is July. On July 25th, we have another journal entry. Now, whatever we purchase, we're selling it. Now, the sales is not, we're not concerned with the sales, right? That's not our concern. Our with cost of goods sold and reducing the inventory. If you want, we can do that as well. But let's focus first on the sales on the account. So that will be debit. We're going to have debit, like that will be accounts receivables. And then we're going to have credit sales. Sales will be 30,000. And let's make this one here like this. 30,000, then we're going to have credit GST, obviously, and that GST will be payable. And GST payable will be $1,500, and accounts receivables will be equal to 30,000 plus 1,100, that's $31,500. Now, if you want to do the second, if the question required that one, on July 25th, you can do the write-off of the inventory, pretending that all the inventory is gone. So that will be debit cost of goods sold. Cost of goods sold with 20,000. Let's say 20,000 is we sold all the inventory, and then we're going to have credit inventory with 20,000, and inventory is gone. But that's not the point of this question. The question is now on August 10, that's the interesting part. On August 10, we have to identify and remit the GST to receiver general. So what we have to figure out here, we have one GST account here, which is recoverable. Let's go it with green because we have to get the money back, and payable, that's red, because we have to pay the money to the government. So what we're going to do, first we have to close both of those accounts. If the account has a debit, we can close it with credit. If the account has a credit, we have to close it with debit. So let's close first the credit account. Debit, GST, recoverable, payables, GST payable. And payable, we're going to close it with exactly the same amount, 1,500. So that GST gone. Next one, let's close the recoverable, credit, GST recoverable. And we're going to close it with exactly the same amount, 1,000. So those accounts now are closed. The question is, are we in balance and what do we need, debit or credit? That will determine, since we're closing everything through cash, that will determine do we have to pay cash or do we have to receive cash? Yes, your mom.
We have to debit cash by $500. I did the math in my head.
You have to debit cash with $500. So
Sorry,
let's
sorry. I meant credit. I
credit.
changed
Okay,
my mind.
okay, good.
Yeah,
Cash
yeah,
with
that made sense.
$500, and we're done, right?
Yeah, yeah.
So don't make this mistake on the exam. Don't debit cash, credit cash. If the obviously, if the money that you're collecting from sales are more than the money that you pay on the purchase, you own the government money, the difference. That's how you should look at it. So that will be your question one. Okay. So the other question that you're gonna see is a question about the warranty. Again, you're not gonna see this question. You're gonna see something similar. The journal entry that you have to do will be the same though. So let's think about it this one. Now there's a new company which makes sells 20,000 units at cost of 40,000 per unit. The company offer 1 year warranty that replaces any defected unit with one new unit. The company estimated the warranty replacement at 3% of the units sold. The actual warranty replacement was 475 units. Record the warranty expenses and warranty payment on the December 31st. Note that this company estimate warranty payable at the end of the period. It's not during the period, at the end of the period. So the question here doesn't ask for sales, but it doesn't hurt if we do the sales. Let's pretend that we're doing sales. Let's choose one date. The date is randomly chosen. August 31st, randomly choosing the date. Debit here, debit will be accounts receivables. Let's say accounts receivables, we're not collecting the cash. And that will be with selling 20,000 units times $40 per unit. And our sales will be 20,000, 1, 2, 3, times $40 per unit. That will be $800,000. That will be our sales. Again, the date is chosen randomly. It's not related to the year end, nothing like that. And then we have credit sales, which credit sales is exactly the same amount, $800,000. Now, the next thing that we have to do, the year end comes and we estimating the warranty replacement of 3% of unit sold. So what do we have to do? How many units we selling? We're selling 20,000 units. Time 3% and time the cost per unit, which is $40. Because if we calculate only 3% of the 20,000 units, that doesn't give a cost. We cannot do the journal entry because that's number of units. And the balance sheet or anyway on the journal entry, we're not putting number of units. Imagine this, in going to the grocery store, you buy 20 potatoes and you're doing journal entry debit, inventory 20 potatoes and credit cash, I don't know how much now. Or let's say you pay $3 and debit $3. So on one side you have 20 potatoes on the balance sheet, on the other side you have $3 taking cash. That doesn't make sense, right? So let's stay with the dollar amount. That's why we need the dollar amount. So what we're gonna do? We're gonna get 20,000, 1, 2, 3, time 0.3%, 0.3, time $40 per unit. And that's gonna give us the warranty of 24,000. So on the review here, you have 24,000 on the warranty. So now let's do the journal entry on December 31st. It says the warranty expenses and the warranty payments, everything is done on December 31st to match the periods of the sales, which is the year of sales. So December 31st, we're going to have debit warranty expenses. If you're wondering which account to debit, it says in the question, clearly says record warranty expenses. So which account I have to debit? Warranty expenses. It says in the question. So don't come with this statement, I don't know which account to debit. It says in the question. You have to record the warranty expenses. Then record it. Warranty, debit, warranty expenses. If you don't know which account, again, read the question again. And how much we're going to record here? 24,000. Okay? And then we have to credit an account. For the credit, since what we did with this number, we estimated, correct? And again, it says in the question, company estimate warranty at 3% of the unit sales. So which account we're gonna get? We can create estimated warranty liability. And that will be exactly the same amount. That's my warranty liability. Now let's see how many units I have replaced during the year. I have replaced 475 units at dollar amount of $40 per unit, which give me the actual replacement of 475 times $40, and that's going to give me $19,000. So what do you have to do? Again on December 31st, it says on the question, December 31st, here. Let's move it on the different color so you can actually see it. On December 31st, let's do it this entry now. December 31st, what we have to do? We have to replace those units. Because here it says the actual warranty replacements. It's not payments, it's replacements. So how can we replace it? By using inventory. So which account we're going to create? Create inventory. With how much we're gonna create it? We're gonna create it with 19,000. That's 19,000 because it's 475 units were replaced. Now the question is which account we're gonna debit. Can I debit again warranty expense? No, but I can easily debit the account called estimated warranty liability with same amount of the replacement, which is $19,000. Now, the question is how much is the estimated warranty payable? Actually, we can use now estimated warranty payable. Since in the question says estimated warranty payable, now that means I have to use this account. Let's use this account and let's change our terminology instead of warranty liability to warranty payable. Why? Because the questions tell us which account to use payable. Now, the good thing for you, you don't have to write this amount. You don't have to type it. You don't have to do anything. It's going to be drop down menu and you can choose the account, which makes your life way more easy than mine. See, I have to type so I can make a spelling mistake and this and this and this. You don't have to. It's a drop down menu, boom, done. Monica, is there a question? So what we have to do now, I have to calculate what's happened with my warranty, estimated warranty liability account or warranty payable account in this particular case. So the account again is estimated warranty payable. C and Control V here, capitalize it, estimated warranty payable. And what we're going to have on this account, we're going to have something coming in, going out, and we see what's the balance here. We have, in this account, we have credit on December 31st. First, we have a credit of $24,000. 24, 1, 2, 3. Let's make it like this one. That's my credit. And then I have a debit. That's my debit. In the same account, I have debit of 19,000. Now, since this is a liability account, the normal balance will be credit. So the ending balance of this account will be credit. It's credit on this side, debit on the other side. And the debit who's going to be the credit ending balance of this account will be equal to 24 minus 19. Very complex calculation of two numbers which are estimated, and you come up with the answer of $5,000 ending balance. And you're done with this question. That's how long it's going to take you to solve this very difficult problem with the warranty. But I still want you to know how to calculate the warranty. I don't want you to underestimate the. Okay, so required. This is the Ken and Ivan form partnership investing $110,000 Ken and $200,000 Ivan respectively. Determine the shares of the net income and net losses for each of the following situation. First one, net loss is 160,000 and the partnership have no written partnership agreement. Now, what was the rule? If there's no written partnership agreement, how they share profit and losses? Hmm? If there's no partnership agreement,
It's 50-50.
50-50. So A is on 50-50. If there's no written agreement, 50-50. That's why make sure you have a prenup agreement. Let's turn. Recording is on. So what we're sharing? We're sharing loss of $160,000. How much they gonna get? How much Ken gets? How much Ivan gets?
80,000 Ken, 80,000 Ivan.
80,000,
Yeah, I did it off the top of my head.
80,000, and 80,000. Okay, total is 160, isn't it? Now it's positive. So let's make it negative. So it's gonna be loss. Here 80,000, and here will be another 80,000. So in total, loss of 160. Scenario B. Let's go to scenario B. What's happened with that scenario A, that scenario B? Scenario B, net income, now we have income. And the partner agreement state that the partners share profit and share based on their capital investments. So investment, how much they invested? Ken investment 110, 1, 2, 3, and Ivan invested 200,000. How much is the total investment? 310. Based on the total investment, what's the share of Ken? Share of Ken is 35%. Let's make it percentage. And share of Ivan is whatever left of 100. Should be 65%. So now they have a gain of dollar amount 108, 500. So how much Ken's gonna get? Ken's gonna get 108, 500 times 35%. Ivan's gonna get the rest. 108, 500 times 65%. Total, they're gonna get exactly 108,000. So loss of 160 will be divided this way. Gain of 108 is gonna be divided this way. And the second scenario, C was gonna be now the net income is 300,000. The first 130 share based on their partnership capital investment. The next 100,000 share based on the partnership service with define Denfield. Denfield, who is Denfield? Ken received 20% and Ivan received 80%. The remaining is shared equally. So that will be interesting now. So let's do the different calculation here. Let's put it, we have to allocate net income of 310. And that income first be first based on their investment. First 132 share based on their partnership capital investment. So that will be number, let's put it here, A. Investment, how much the investment? Investment is right here. And now I'm gonna move this one away so that doesn't mix with our calculation. So the investment is 3565. So based on this, they're gonna share 132, 1, 2, 3. So first one, actually no, I wanna put it not on here. I'm gonna put it right here. 132, 1, 2, 3. So I can use this amount. First one getting 132 times 35%. Second one gets 132 times 65%. In total, they're sharing exactly 132. How much left after these calculations when they allocating this? How much left for allocation? That will be 310 minus 132, 178 left for allocation. Okay, next one. Next $100,000 B, $100,000. They're gonna share it based on the partnership service, which is Ken gets 20%, Ivan gets 80%. So how much Ken's gonna get? This one times 20%. Ivan's gonna get this one times 80%. Boom. So the total that we're gonna share is $100,000. After this allocation, how much left to share? This one minus 100,000, left 78. So what's going to happen with the remaining 78? Remaining 78 will be split 50-50, says equally. So number C here will be the 78, 1, 2, 3. It's going to be split 50% to 50%. So that's going to give us 78 times 50%. And another 78 times 50%. In total, they're gonna share 78,000. And how much left for sharing? That should be equal to 0. Minus this one should be equal to 0, left nothing. Now let's see how capital account or net income allocation. Let's go net income allocated. How much Ken's gonna get? Ken's gonna get this one plus this one plus this one. So he's gonna get that amount. Ivan's gonna get similar amount. In total, how much they gonna share? Exactly 310, which is our net income. Don't forget, this is the amount that they're sharing, net income, so that has to match the net income after the sharing, after allocation. So what will be the allocation? Allocation will be right here. And that's your answer. As you can see, this question, these people decided to form a partnership. They contributed first person number one, contributed equipment with the book value. Let's make it smaller. The book value is 69, inventory paid 22, and the cash 20,000. The equipment and inventory have a current market value, so the book value, that's irrelevant for us, and how much they paid, that's irrelevant for us. We chasing the current market value. The current value market of the equipment is 50,000, and inventory fair market value 16,500 respectively, and cash is cash. Fair market value of the cash is 20,000. That's not going to change. Now, they also had the debt on the equipment for 20,000. So Accounts payable, they also contributed accounts payable, that's negative 20,000. Okay, great. Second person, number two, he contributed office equipment, book value 44 and cash 68. So he, second person, equipment, book value is relevant again. We're chasing the current fair market value, which is 22, 1, 2, 3. And he also contributed cash with the current market value of $68,000. So the two partners failed to agree on the profit and loss sharing ratio. For the first month of June, the partnership loss was $4,500. So let's see how much their capital. First partner capital is that much, and the second partner capital is that much. In total, the capital they have is, sorry, should be that much. Total capital, $156,500. So now, since they failed to agree on the partnership losses, the first month of June, they have loss of 4,500. So the question is, how much loss get the first person? How much loss get the second person when we don't have a contract?
50-50.
50-50. So all the calculation that I did was for nothing with the capital and everything. Why? Because it's irrelevant. All the capital and everything was irrelevant in this case. If they have loss of 4,500, first gonna get 4,500 times 50%, and the second's gonna get exactly the same amount, 4,500 times 50%. In total, loss they're gonna share is 4,500. Let's make it loss now. Negative here, and another negative here, and that's your loss. Okay, second, partners withdraw no assets during June. So there will no June. What is each partner's capital balance on June 30th? Prepare T account for each of the partners. So in this case, you can prepare the T account, but we can easily calculate what will be the first partner account. So capital for the first partner is gonna be, he started with 66,500 plus the loss. That's how much will be. The second partner is gonna be similar. It's gonna be that much. So now if we have to prepare the T accounts, I'm gonna go somewhere that I have T account, like this account, and I'm gonna use this account since it's partners. Their balance will be a credit side. Let me copy this one. Account, and I'm gonna flip it to right here, and that's will be capital account of number one, and then will be the capital account for number two. Those will be different. This looks okay. I don't need anything else here. And the capital for number two is gonna be right here. That seems right. Number two. Match those two cells to be nice, presentable. So what's happened here? He invested 66,500. We debit his capital account with negative that amount, and his capital is 64,250, which is exactly here. And the same thing we're gonna have with number two. He invested 90,000. From the first month of operation, he was lucky to get only loss of 2,500, 2,250. So his capital went to 27,500. So this is your loss here. Let's mark it with the right thing. And the first one is capital, which is this one and this one. And that's your question. Let's resume recording. So the question again is, company pays 16 million to acquire 40% investment of this company. Further, assume that this company reported net income of 840,000 for the first year and declared and paid cash dividend of 875,000. Record the following entry on January 1st, purchase of the investment. Let's go with the purchase of the investment. Now, again, the good thing with you is you don't have to write the accounts. So what you're gonna do, you're gonna have a drop-down menu, which drop-down menu you have to choose the account. And that will be debit. In this case, debit will be equity method investment. I'm gonna shorten it because I don't wanna write the entire name here. You can scratch your head during the exam and get the right entry. So how can you get the right entry? Well, very simple. This is a strategic investment, obviously, since you require more than 20%, that's a strategic investment. It doesn't give you control over the company, but to give you significant influence. If you give it a significant influence, that means you have to use the equity method. If using the equity method, we're going to use the equity method investment. We're going to debit that account with $16 million. And we're going to credit. Which account we're going to create? Come on, people. Which account we're going to create? Come on, we have to finish at 8:30. Go for it.
I was about to say revenue.
Revenue.
Oh, yikes. Sorry, cat. No, it's not cat.
I'm investing. I'm investing.
Okay, so cash?
Can I do anything else? Can I buy investment with revenue?
No,
Who's
you
gonna,
can't. Sorry, I just made a mistake. Sorry
right?
about that.
No, no, no. Think about it. Right? Think about it. Can I invest? Can I invest by in company by giving them revenue? No. Can I invest by giving them accounts receivables? No. Can I invest by giving them accounts payable? No. Can I invest by giving them depreciation? No. Can I invest by giving them asset? No. What do people want? They want cash. If you want to invest, show me the money. 16,000. 16 million in this case, sorry. Okay. Then comes to the point that this company at the year end, they have a net income. Now, don't forget, here we owe 40% of this company, or 40% of the shares. So on December 31st, the company declared net income of 1,840,123. How much is ours? They have that income. How much is our income?
I was about to say 60% of that.
Why 60? We purchased 40% of shares of this
Oh,
company.
sorry. We made 40%. So
40%. Okay.
40%.
So on December 31st, what's going to happen now? December 31st, debit Which account I'm gonna debit? Gonna get lazy now. This account. This one time 40%. Now tell me, they making income. Which account I'm gonna create now?
Revenue?
What revenue?
Uh, Investment revenue or equity method investment revenue?
Okay.
Okay, I don't think I grasped the
Any
concept.
any other suggestions? What account you said?
Me?
Yes.
I said first equity method investment revenue or in
Okay, let's go with that one. So again, you don't have to make a guesses here because that option will be not available for you. You have to choose the right account. And that seems to be the right account. Why? Because again, you're going to have a drop-down menu, which is going to give you options. So you're going to debit equity method investment. So your investment is going to go up, but now you have a revenue because their revenue become your revenue. Their net income becomes your net income. Also, they declare can pay cash dividend. 31st, there's a cash dividend of 875. How much of that cash dividend we get? How much of that dividend people we get? 40%, right? We cannot get more because we own only 40%. Whatever they give us, 40% is ours. Let's get it. Debit. Let's get this cash. That's why we invested, to get the cash. How much we gonna get? 875 times 40%. So we're gonna get 350. And which account we're gonna credit? We're gonna create equity method investment. With how much? With exactly the same. No, that will be here. So actually this one is gonna go here. 875 times 40%, and this one's gonna come right in here, same amount. So what's happened with our investment? Our investment, if we have to do the T account with for our investment, it's gonna look like this. First, we invested 16 million, 123, 123. Then we receive 1840, 123. And then we get a dividend at 350, 123. So our ending balance in this account will be equal to this one plus this one minus that one. Boom, done. That's how much is the equity method, our investment on the equity method on the balance sheet. Do we have to reevaluate at the end of the period? No, because it's already at the fair market value. Okay, so let's keep going with this. That's question number 5. Question number 5. Let's go question number 6. All right, question number 6. Let me find you something interesting for question number 6. Let's see if I can find something easily. Okay, let's do the changes for this one. That shouldn't be the amount of the net income, should be only the amount that we're debiting. So let's highlight it. First debit comes from here. That's your blue. Second debit comes from here. That's your green. That's your green. That's your green again. And the last one, the credit comes from right here. Let's insert one line here. Credit comes from here, which is right. And that's how we get the ending balance for the our account, which is the equity method investment account. Let's label the account, make it professional, and those two together. Watch those two together. That's your debit, and that's your credit on this side. And that's way better. Now we can move to question 6, which question 6 we're gonna deal now with the common shares, which are purchase a long-term investment paying 92 per share. The expert no significant influence corporation commission on the purchase was $1,100. So let's go. We have to following that journalize the following investment transactions. First one, debit. No, let's put the date August 06, and that will be debit. We're gonna purchase common shares, which is long-term investment amount. Yes. And in that long-term investment, we're gonna leave it here. That one will be for the credit. Then we're gonna have here debit, and here will be credit. Put it this way. Also, we paid commission, so let's go debit. Commission expenses can be their question. No. Commission expense. And that will be here, debit will be equal to 1,600 times $92 and 47,200. And commission expense 1,100 and credit will be cash. And that's gonna be equal to this one plus this one. Somebody asked for combined entry. That's your combined entry. Now we cover the combined entry. We don't have to go back to combined entry. Now let's go to the next one. On September 12th, we receive a cash dividend of 1.95 per share. So let's get that cash dividend, debit cash. And since we have 1,600 shares, which pays us 1.95 dividend per share, cash dividend, we get 3,000. And let's cut it from here, move it here, 3,120. Credit will be dividend revenue. And that dividend revenue will be exactly the same amount. We're not gonna go with the, I'm not gonna break in this entry because that's not how it's gonna be on the exam. So there's no value for you to break it on the entry. If you want to do it, however, once I give you the access to the Excel spreadsheet, you can break it the way you want to break it. Now let's go with the other one. On November 23, this company received 240 Rhodes common shares at 50% in a 50% share dividend. That's something new. Now you're getting the share dividend, 240 shares. The question is there journal entry here? Monica, and you think right. So what we have to adjust? No journal entry, but we have to adjust the number of shares of the common shares. So now we originally we had 1,600, correct? Now that become different.
1,840 common shares. I did
So
it
now
off
we
the top
have
of my head.
1,600 times 1.15, right? 1,840 shares, right? That's the new number of shares.
Yeah.
Then we come December 04th and we sold everything. When we sell the shares, what we're gonna get? Monica?
We're gonna get sh cash. Oops, sorry. You were
That's
addressing
okay.
it.
That's okay. She already knows. Time 90. We get the cash. Why we get the cash? Because we sold the shares, correct? Do we have the shares? Credit. We have to credit those shares. Long-term investment. Since that's gone, long-term investment 147, 200 gone. What happened now? Do you have a gain or loss?
We have a loss. Actually, sorry, it's a gain. Yikes. It's a
So
gain.
credit, we're gonna get gain on long-term investment,
Yeah.
which is equal to the this one minus that one. Now that's for the cash. Let's pay this commission debit. That will be still December 04. Debit commission expense with 900 and let's pay it cash credit. Cash. Now, if you want to come to the combine entry, do combine entry on the probably PS is gonna ask you combine entry, so you add the commission expense here and they reduce the cash if you have to do that. And that's all with this question. That's question number 6. Let me see if there's any other question here that I want we to go over on those, especially the one that catching the fair value valuation allowance account. That will be interesting. Well, let me see if I have anything like that. Let's go with this. Let's move to the question number 7, which is gonna give you access to new information, which will be this company, oops, Let's put it again. This company purchased syrup that sells in Canada. They use American dollars. Let's see what they did and how they did it. Let's format this cells first because I don't like the alignment. At the time, on June 2nd, a purchase on the purchase, the exchange rate was 133.61. When the payment was made, let's see what's happened now. The payment was made July 28th, exchange rate was 126.93. Journalize the both transactions. Okay, let's do our journal entry. First one is on June number 2nd. Debit. Which account we gonna debit? That should be inventory. Inventory, and we purchase the inventory for 10,600 US dollars. But since we're in Canada, we cannot record it that in US dollars. We have to move to Canadian dollars. Exchange rate, we have it 133.61 for 1 US dollar. So that will be 10,600 times 1.3361. So it's going to cost us 141, 14,162.66 Canadian. And since we haven't purchased on account, it's on account, let's credit our accounts payable with the same amount. Now, everything looks good until July 28th. What's happened on July 28th? We pay this accounts payable, credit accounts payable. How much was my accounts payable? That one. That one's gone. But now we have to pay it cash. But for that one, for those 10,600, I exchange it for, exchange rate is now 1.2693. And that creates a difference. And in this way, the difference is on the credit side. So if it's on the credit side, we're gonna have foreign currency exchange gain. Credit, foreign currency exchange gain, which will be the difference between debit. Oh, that debit should be on different place. I'm gonna move it right away and credit. So let's cut from here and paste it here. And that will be our transaction. There's literally nothing in this question. You just have to generalize the inventory and then accounts payable and then payment of the accounts payable with the cash and see where the difference is. Difference either going to be on debit side and this one is not credit, that will be debit here. It is going to be on debit side, it is going to be on credit side. What chapter this one? Chapter 15, Lily. So those questions 5, 6, 7, chapter 15. So 1, 2 is chapter 11, 3, 4, chapter 12, 5, 6, 7, chapter 15. Now let's go to another one series of this question, which will be for the opposite side. So again, the question, Thomas decided to sell the shoes in Germany on March 14th, $2.4 million euro. On the date of the sale, the euro was 1.6. Then he collected half of the receivables on April 19th and the other half on May 10th. And we have to see what's the foreign currency gain or loss and what exactly happening. Let's go with the first one. Let's go March 14th. What's happened on March 14th? Obviously, he sold it, the inventory. So he's going to get debit accounts receivables. He's not going to get anything, cash or anything like that. That will be our debit and that will be our credit here. He's not going to get cash. He's not going to get anything. He's going to get accounts receivables because these people, they don't pay. 2.4 million euro, not yet. So his accounts receivables, however, are 2.4 million euro time 1.6. So he has to collect 3,840,000 Canadian dollars. On the day of the sale, obviously the credit's gonna go credit sales revenue. And that will be exactly the same amount. Now the first payment date comes, which is in this case April 19th. On April 19th, he getting only $1.2 million. So debit cash. He's getting half of it. Now, how much is the 1.2 million euro is the half? But he getting half of the accounts receivables as well. So credit will be accounts receivables, and he's gonna collect half of this divided by 2. Now let's see how much 1.2 million euro is gonna worth as a Canadian. That's gonna be equal to 1.2 million, 123, times 1.59. So in this case, we need more debit. So if we need debit, unfortunately for Thomas, he's going to have debit foreign currency, foreign currency exchange loss in this case, which will be equal to this amount minus the cash that equivalent that he get in Canadian dollar for 1.2 million euro. Then we're going to the next day, which is May 10. And in the May 10, he collected the other half, debit cash, but he closed the entire accounts receivables. Put the other divided by 2, 1,920,000 Canadian. Now, how much worth it the 1.2 million euro on that day? Time 1.64. Now, as equivalent in Canadian dollar, he getting more. So in this case, he's going to have credit, foreign currency exchange gain. Since we want it on the credit side, that will be our gain. So in the overall, is he losing or how much is the overall gain or loss? So he has a loss of 12,000 and he has a gain of 48. So in overall, he's positive. He has a foreign currency gain of this 48 minus 12, which is $36,000. Foreign currency exchange, and that will be transferred into. Make sense?